In terms of the business, Iqbal Khan has been appointed, so you have now two co-heads within the wealth management. Apparently he had 60 days to come up with a big plan. I've not seen a red headline that Iqbal's 60-day plan. What's the intention between you and Iqbal in terms of wealth management? What's top of his agenda?
Well, he has still 10 days to go, so I'm not going to... and he's working with Tom Naratil and I'm sure we're not going to disclose any new plan on December 1st. I mean, at the end of the day, the biggest part of his job is to help execute the current plan. And of course, I expect him also to come up with new ideas on how to bring our business forward. But I don't really expect big revolutions.
Okay, so not big revolutions, but are you prepared to countenance additional leverage? He wants to bring that lending mentality that he did at Credit Suisse. I know you lend, but the idea, I understand, is to scale up. Are you open to scaling up with leverage on the wealth management side more than you currently do?
Look, we highlighted lending as a top priority well before Iqbal joined the bank. So again, it's all about helping us executing our strategy than having a new priorities.
I think you spoke to us in New York and you said you're obsessed by cuts, so you're focused on cuts, very focused on cuts. Is 2020 going to be another year of additional, I suppose, efficiencies within the bank without major headcount reduction?
So the issue that is not very visible, but I can assure you that is what's going on, is that the cost base is quite fixed. But if you look at the gross outgoing cost, I mean, we are cutting costs 2 to 3% a year, other than technology and regulatory costs, in order to fund those two items. So we have to be focused in continuing to cut costs, to free up resources for investments in technology. Our technology agenda and digital agenda is very ambitious, and we also have regulatory costs. Think about the LIBOR transition, for example, right now. The establishment of our European bank post-Brexit. Those are all costs that we need to absorb by focusing on getting better efficiencies in the system. But we are also investing in the technology for the future. How do we make our client experience a better one? How do we get better products through technology? And how do we create efficiency in the back office through technology? Those are all investments that needs to be made in the next few years in order to stay competitive and capture the growth that we expect to see.
How do you think the investment bank landscape is going to develop over the next couple of years? I mean, we've talked about scale. You've used the word scale, and banks not, it's not a question of being too big to fail, it's a question of scale. Talk to me about the landscape for the investment banking.
Well, the investment bank business is going to depend on two things. First of all, are we going to see a more balanced activity level in terms of capital markets, IPOs, M&A outside the US versus the US going forward? And the second question is, are we going to see a higher level of realized volatilities in financial markets? Because although we have reached all-time highs in equities and many other asset classes, if you look at the underlying volatility, it's not very constructive for the investment bank businesses for trading and sales activity. So,
how much patience do you have for that? How much tolerance do you have to endure, let's say, another year of repressed volatility?
No, we constantly look at the situation. We try to be focused on not taking too quick actions just for the sake of overreacting, but also we realize that there are fundamental changes in our industry, in the investment banking industry as well, and for example, that's the reason why we make a lot of investment in technology to take down costs and being able to give the same services in a more efficient way.
And in terms of, you talk about the US a couple of times now, but in terms of the banks in the US, let's say, versus yourself and some of the other European peers, are they just going to dominate continually? You have a huge presence in the US with wealth management, with Tom. So what is the challenge with the US banks?
Well, the challenge right now, as it is that you need to really pick up the battlefields you want to play in the competitive landscape. We are very focused. We are global, but also very focused in what we do, and this is the best strategy for UBS.
To the markets, obviously we had the Fed minutes last night. There was a wonderful line from Wells Fargo. They just don't seem to have the wherewithal to really want to cut any more. When you look at what the Fed has done this year, I want to get a sense of what you make of this expansion of the balance sheet. It's risen by 7% since they started expanding again in quite a short period of time. What do you make of that?
Well, of course, they are reacting to the economic slowdown. I think that so far has been appropriate. I don't see, honestly, the necessity to go much further.
Everybody talks about recession, so I just want to get a sense, have you seen anything in the numbers, anything in the data from the clients that suggests to you that there's a recession-like trend in anything the clients are doing?
Well, I mean, the leading indicator for us is that cash levels are very high. No matter if you talk to the clients as an entrepreneur or as an investor, they are quite cautious in respect of how they invest and
but what shifts that? What changes that thinking, Sergio? Because what they worry about are probably the same kind of things that you worry about.
Is geopolitical, geoeconomic risks and are still unresolved, and as long as those things are not clear, you're not going to see a lot of change in this attitude.
Were you heartened by the deflection of the Fed? They talked about negative rates. And more or less, Adam, I'm upsumming here, negative rates aren't something that they think is a policy tool for them at the moment. Is that good news? I know what you think about negative rates, but
I don't see. Look, negative rates or low rates are in some cases a necessary tool, but only for a very short period of time. Right now, we see a lot of negative negative consequences of negative rates. So I don't really believe that the US would really resolve any issues by introducing negative rates.
You just introduced some negative rates on some of the client deposits. I'm curious from an FX point of view. I had one or two guests that said to me, are you going to see a big move? People are going to switch out of Swiss. They're going to switch into dollars. They're going to switch into anything else. Has there been any even incremental move on currency switches as a result of the policy action?
So far not. I think that it's not likely to happen very soon, but as time goes by, if rates stays at this level, you will see most likely also the application of negative rates of the banking system to go down, not touching the lower savers or depositors, but for sure it's going to change the behavior of investors. Of course, we are all looking at way to try to avoid that for our clients, but it's almost inevitable that if rates stays where they are, the banking system is going to be forced to pass the cost and the pain.